Hello, time for another video. And this one, what I want to do is I want to do what I did before in drawing a line over the 18 average and a longer term time frame using the 18 average highs, lows, and closes, and then view this on the daily term time frame. Then after that, I'm going to explain how you would do so on a spreadsheet, and it is much easier to not use a spreadsheet, but to use the chalkboard and explain it there. Because it's actually, as I just think in my head, it's very easy to calculate. You're going to need a lot of columns, but it'll be easy to calculate. All right. So what I'm going to do is I'm not going to do the older data. It's just no need for such. So I'm going to do the best. Now, one thing you can do is just don't have many candles and just draw it like, well, that wasn't even close. And that's pretty good. So I'm going to stop that. And if I mistake it from here, I can Control Z it, which is undo, or Control Z if you say it differently. Now, here's the deal. I don't need to draw it down here because I'm going to know that it's well above it. So I can even do stuff like, well, that's not going to work. Draw it like this. And that's not going to look too good on a daily term time frame. And then as I know the areas in which they come up from, and there's no need for even me to draw the 18 average of lows until, of course, right here. Because it's obviously well extended from such as it's having its bull market run. As far as other times, if you want an easy way to do it is, well, one was, I mean, I'm not even going to go back that far anyway, so I don't need to draw any more 18 lows. Now, technically, I could just go like this and format this to close and then re-put it back to low later. That's just as easy. And notice here how it's really crunched to the highs. This is very common because I don't show the 18 average of closes too often, but I used to see it all the time. And I know, and mathematically it makes sense when you think about it, that when you have a bull run like this, the 18 of closes is pretty much near the highs. But the closes are pretty much what the highs are every time when you see these green candles. And the same is true when you have those red candle down moves as well. And when it's neutral or when you get nice little either balanced up and down moves and a lot of those wick sticks or the lines, then you're going to get it nicely in the middle more times than not. And another way of looking at it is doing a calculation to see, another indicator is the difference between the close to the high and the high to the low. And you get a totally different chart. That's something where I've already explained it. I would have to do both the chalkboard and then explain the mathematics and really show it in a spreadsheet. Where what I'm going to show later doesn't really need to be explained in a spreadsheet. So the 18 average of closes, we can see, but support here. I mean, I really don't even put a line there. I can just see, because I'm only going to be looking at this recent time. I can see right here that the closes was successful support on those occasions. But you know what? Yeah, because I'm going to be looking at shorter term time frames. So I'm going to see 12 periods. I'm going the daily, so this is going to be a 12 difference. And that's something I'm going to be talking about in the spreadsheet as well, is the differentials of the two time frames that you would be doing. So then I've got what I need. So then let's adjust this back to the low because we're going to be going to the daily term. And see what we get. The fall on May the 23rd is when it left the more longer term newly declining 18 average. You had the failed move amongst here. So be it. 18 average of closes was this resistance test. And this is why I kind of should be putting it in, but it's actually better to do it this way. But you can see how well that the 18 average, to me it'd be more, yeah, it just works better this way. I wish I could find a way of doing this so it'd be, I guess I'll just have to do it when I need to do it. And the more I do it, the easier it'll get to do. Or the easier it'll be able to read when I do this more often. Anyway. So in this situation, all these rally attempts, we can see, okay, well, we got to this little level here that it makes it hard to trust the rally, but you can see more that the area in which it's going to get pushed down from. Another way of thinking about this is almost like, however you want to look at a battle, like a fight-ish kind of deal. Like you could almost view it as a good example might be an EMA fight, a boxing fight, or even in school, someone gets picked on like a bully. And that one might be the better one. Or the situation, or a video game where you're having easy and harder times in life, like a boss level, that might be the better one. It's not a challenge to make it to the bosses, if you will. The first boss is coming in right now at 72. And sometimes they'll knock you down, and maybe not that hard. Meaning, you go up to it, you only go down a bit, you don't get knocked hard, then you beat it, you go to the next boss, and so on and so forth. So when you're looking at spots for bear market rallies, this would be one indicator, and which would be really interesting in the use. And when we scroll back, and that's why when you put these lines in, I have to push the cross button every time just so I can use my mouse to scroll back. And a little nuisance, but I do like this drawing tool. So in here, you find really no support. And if you did, we're talking like hourly time frames and such only. And you could, I was going to say you could look at this on the hourly, and I kind of could now, but I won't. So we find support in the closes, and we pretty much resist the highs. So you can use this within the indicator as it's doing that with this 18. As it's resisting the closes, it's resisting in this 18 average that's declining. So you got one that was rising because this was flipping over. So what was a rising, turning neutral, longer term moving average, or resisting the highs, making a move to the newly declining lows, breaking down at this stage roughly around 11.6. Both of these key levels, both the highs on the long term, the lows on the short term. And from this point forward, it's obviously just has not done anything more than neutralize the uptrend, because this is pretty much straight lines for the most part. This really does tell you where the range is. When you look at it from this point of view, and you would have a more longer term 18 like this practically sideways. You got the highs, lows, and the close. And it's interesting. Oh, never mind. This is way back in the past. Let me just go to today again. This was a spot where, as long as it stays in this range, it was sideways. But when you look at this from the 18 perspective, you always got to go well below, at least one leg below the low without breaking it. I mean, that's like, it's got to do something below that to make it decline. Same thing with the rally above the 18 highs. So it's almost, you need 5 lines: the closes, the lows, the highs, and like an upper and lower style band. And I did an upper and lower style band, although the one I did was very volatile. I did it for a reason, to determine high up and down targets. But I really never needed that, and it was really a distracting indicator, so I did remove it a while back, even back in that point. So within this move that has occurred, it has had that extra leg lower. The 18 hasn't really declined too much, for it's still well above this level. That is the longer term one. But it's only had a small move. So it's had a statement made in this situation. Because you only expect, like, if you draw lines, you're drawing more lines like this. I mean, that's really what it comes down to. And one way of doing it is, what's the, even if you use 18 average of closes, there's two ways you could do 18 average of closes. You could do the normal way you would calculate it, or you would do a 50% retracement between the lows and the highs. And by doing the 50% retracement, obviously when I shown the one where the 18 average of highs and closes would be close to each other because of the rally, it would fix that problem. But what it also enable you to do is use the exact same difference that you have from the closes to the highs. You use that from that on the upscale. So half of the distance here would be the one you would move up top. That's one way of you'd be looking at, okay, where would that leg lower be? So this area here would have certainly fit the bill for half the distance from the highs and the lows, or from the close, or the distance from the close and lows. Now technically you can look at this at two fronts. That with this declining moving average, that is declining like that, the extra lower one. And in doing such, all it would have been doing is having the small pierce down below, though really what it's doing is maintaining a trend, but it's doing so as it's slowly pushing lower. So that's microscopically bearish at anything. So it's still in that decision point. And this is making it big because we're having this rally to the 6,500 point. It's making a statement right now, and I'm going to finish it off with a statement, then I'm going to go with the calculations. The statement is this, when I look at it from this perspective. We're going to do one of two things, because this is either the failed breakdown, much higher than where I thought, but I can still see how, on this mechanism, how I can look at it for such. And in a failed move lower, it obviously is a fast move higher. And in the case of when you are going to go from the story I've talked about, the break of 6 to the move to 3, then how is it going to read in the book? Make a story of the charts. Well, having a situation, having a little move below, just a regular leg below in the trading in the shorter term, then in the shorter term come back to that level that was supposed to be support, resist it, which is basically where we would be at now, and then you'd be rolling over. And then when we notice, if that's the case, you're going to always have probably the exact same thing here. And that is, how is support here? And the answer should always be terrible. That's not going to work, and it's probably going to have a fast leg lower. Meaning, if one of the two things occur, that's not that, which is usually pretty much a matching low, maybe a small pierce below, maybe a small or a noticeable but really a deep pullback that's a higher low, something like that, then that's indication of a bottom. And if it does the situation where it doesn't even do that, let's just assume that it does something like this and it maintains that move. And that move would be this. A break of 6,500 that would enter into the, well into the 7,000s. That would be that move. If it does that, what it would, and it was able to either just keep on going from there, because you know when the cryptos do that, they'll do that. They'll just keep going high. But in not that situation, if it's able to then hold around 68, even pierce to 65 is fine. If it does that, holding around 68, 69, 67. And if it's at 67 for not that long, maybe only for 3, 4, 5, 6 days. But and as far as holding, say if it goes up to here, like 83, if it holds, say, 7,200 for like 9 or 10 days, whatever, that would be fine. But if it's just going to be a short-term pullback to here, that's why I'm saying 3 or 4 or 5 days, because it only spent 3 or 4 or 5 days here, and I'm looking at it from that kind of perspective. But generally speaking, getting that failed move. But if it ends up resisting this and going lower like this, it's probably going to be that fast move, and I would expect 3,000 to occur in anywhere between 16 to 16 hours to probably well less than 16 days, probably even closer to 9 to 10. Now, as far as how I would do the spreadsheet, it's relatively easy. First, you need to have the data of the market. You need to have the high, the low, and the close. You don't need the open, but you usually have it. And if you only have, you need 3. Like open and close are pretty much the same anyway. So therefore, I put them in the first early columns like A, B, C, and D, and so on. And places like Bitcoin charts have really good data. So say you have daily term time frame and you have the last several years. You've got all the data, 1,500, 1,700 rows or whichever. I usually start on the bottom and work my way up in spots like this. And for this example, I'm not going to use a front weighted average because that's a very complicated formula, especially when we go into the more longer term moving average. In fact, I dread even thinking about calculating it, so I'm not even going to go there. So I'm going to use a simple moving average because it's easy. And the simple isn't that much different, and it really is close enough to do what you need to do. But with that being said, so you have all those columns in A to D. So now you need to find out what the moving average is. And well, for what your daily points, you're going to need your daily data anyway. So you're going to need the 18 of highs. And you might as well go closes and loses the whole way through if you're going to do it this way, especially with that idea I was talking about. If you do the percentage move, you could do like the extra bump on each one as well. So that'd be something you could do along the way as well. So you'd have the 18 on the high, lows, and the closes. Now you have to determine how many periods larger you want to go as your longer term moving average. So if you do something, say, 20 times larger, well, that means when you're calculating your formulas and you want to get the 18 average for that, what you need to do is when you're going to have all of these numbers on the screen, is you're going to have to use one column to find out what the 18 average of highs or what the 18 average would be. And you would need to figure out, okay, what would the previous day be? Now, I guess I was thinking of it from the 18 average of highs and lows perspective, where I would take, if you're doing, say, 20, I would take the previous 20 days and I would find out what the maximum and the minimum is, and even the closes, and that's what I would automatically get. And then in the column before that, but realistically speaking, it's really going to be, hang on a second. And thinking further, yeah, you would get the numbers for each one. So you would have to do, if you were, say, doing 20 more, you would have to get 20 numbers. So you'd have to have one for each column. So this might be rows 800 to 781 for the data. This would be 780 to 761. And so on and so forth until you have all 20. And then you would have 20 columns in a row with the numbers. You could then take the average of those 20 numbers, and that's what the number would be. So that's how you would calculate it. It would take many columns to do. But if you know the difference of which term do you want, how many X larger, if you're going to do 15 times larger, you would have like 15 columns. 30 times larger, you would have like 30 columns. And that's where you would end up getting the specific pivot point for that number. So then I'm going to conclude this video, and have yourself a great day. Bye-bye.